Okay, well, I make it 10 a.m. So welcome to our webinar this morning. Delighted to be joined today by Craig Hughes, Tax Director and Head of Tax at Brown Butler, and also Linda Cooper, our Audit Director. So welcome to you both. This webinar is all for the charity sector. And as you can see, it's entitled Emergence from Lockdown. And it's all about how charities can pivot, improve their resilience, particularly apt in light of the weekend's announcements. We will be recording this webinar, so an on-demand version will be made available to anybody that's registered and attended this event. That'll be on the website later on today. And we do have time at the end of the session today if you've got any questions. If you're familiar with using Zoom, please use the Q&A tool, which will be on your Zoom toolbar. That gives you the opportunity to ask Linda or Craig any questions as we go along. We'll probably leave it until the end to answer all of those, but we'll try and answer as many as we can before we finish the webinar today. So I will now hand over to Linda and Craig, and I hope you enjoy the content. Over to you.
Thank you, Jo. So, been introduced to Craig and myself for this morning's webinar. So we're going to look at what we see the impact of COVID-19 is on the charity sector. At the moment, I think the main thing that we're seeing with our clients is probably a loss of income. They're finding that, some of the income streams that they would have expected, donations in particularly, have reduced or stopped in some cases. There are then the issues about job retention scheme and furloughing their staff, and unfortunately some job losses that we're probably going to see coming in the sector. This means that charities are now looking at needing to adapt to new ways of working, and particularly for fundraising. And I think the main thing is to have tighter cash flow. We are seeing some going concern issues for charities, and therefore is the possibility of more mergers in the future. When we started this webinar, we decided that we were going to use the can you pivot your charity? So defining what pivoting means was my starting point. I think we'd all know what a pivot is in the general sense, something that it's the main thing that you work around. From a business sense, it's probably a substantive change to one or more of the 9 business model components. And that means that, we're not just looking at cutting costs here. We're looking at how you can change your organisation in various ways. The one that I liked the best, the definition, was the term pivot is a buzzword now used. And it's looking at a range of changes from mild to dramatic. A pivot is intended to help look at a business recovery from a tough period, and I think we'd all agree that that's what we're facing at the moment, and looking at what changes to your business model you can make to make that happen. Craig's going to talk through some examples that we found about organisations in the not-for-profit sector that have actually undertaken this. Craig.
Thank you, Linda. Yes, so the next few slides, I'm just going to run through some examples of several charities who have made successful pivots over the last few months. Starting off with a couple here who have changed the focus of their offering. So, for example, Macmillan Cancer Support has moved from end-of-life palliative care through to a broader purpose of living with cancer. Likewise, Lepra used to be focused on leprosy, have now widened that into other diseases along similar lines. So it's just changed the focus and nature of what those charities have been looking at. The example here is moving from physical events to virtual events, and this is perhaps more of a common theme that's happened over the last 6 months or so. So, for example, Tommy's, they were typically in this particular example here, they were going to do a half marathon around London. Clearly that couldn't take place, so that became a virtual event instead, and actually still extremely successful. And of course it broadened the participation as well. They had over 6,500 participants in just under 1,500 cities in 25 countries. So probably have done better than perhaps they would have done had it solely been focused on the London run. Just leading on from that point around moving into the virtual world and digital world, charities are now using digital channels more so than they would have done before. So brain tumour research here, their Wear a Hat Day would have taken place in schools and offices at the end of March. That turned into a Zoom and YouTube event instead. And again, potentially broadened the participation. 500 new supporters were attracted to that event. Quizzes. Now we've all done quizzes, I'm sure, over the last 6 months to a greater or lesser extent. In this case, the child.org pub quiz became a quarantine quiz. The charity learned how to live stream, and the interesting point here is that they're now selling these quizzes to LinkedIn and Facebook, so that's providing a new revenue stream, a new income stream for the charity, which wouldn't have been there before, quite clearly. Now, one of the major impacts, of course, of the lockdown has been shops, charity shops, and to the extent to which they have been able to open, and to the extent to which the amount of footfall that they can get into the shops. The British Heart Foundation looked at this early on and realised that they had to move to online shopping. This actually allowed them to diversify what they offered, and again potentially broaden the customer base for the charity. And finally, we'll look at charities using subscription-based models to generate additional income. So Comic Relief had online video gaming. Storyhouse in Chester moved to a paid-for streaming service. And the Northern Ballet up in our neck of the woods here, they produced some performances online as well. So again, using different ways of getting to market, trying to replace some of the income that would have been lost through their traditional methods of raising money. And like I say, there's one of the common themes to a lot of these pivots is around using digital technology, moving to online platforms, using social media to a far greater extent than perhaps it would have been used before. So I'll now hand you back to Linda, who will go through some of the risks of pivoting and some of the important areas that you do need to consider from the charity's perspective.
Thank you, Craig. So I think, sort of back in February time, if you looked at charities' risk registers, I'm not sure there would be too many that would have the global pandemic as a significant risk that they needed to consider, but how that has changed in such a short period of time. And, having had the weekend's announcement, it looks like this is set to continue for some time. I think the risk of pivoting is that you must make sure that whatever you change in your strategy is still within your charitable objectives, and that if it is a major shift, how your organisation is going to deal with that. I think the examples that Craig's just run through are very much maybe on an operational and delivery basis, and we therefore need to make sure that you've consulted within your organisation any changes that you're planning. So those that may not immediately seem to be impacted have an opportunity to share any concerns that they have and how they might see it impacting their specific area. And probably most importantly, that you do inform your trustees of what you're planning to change within the organisation. I think there's a need to look at your internal controls and systems to make sure that you are recording these new maybe income streams in an appropriate way, and that you do have the mechanism to make sure that that income is received by the charity, and that you are safeguarding against any frauds at the same time. Maybe you need to widen your view of your organisation and look for other partners and other organisations. Lots of people are looking at changing the ways that they're doing things, particularly going online, and maybe there is another organisation that can support you with this. And fully understanding your financial results. So not only what a specific division is doing, but maybe if you have overheads that are more centralised, how those costs are going to be covered. I think it's really important that you fully understand the costs that your organisation is incurring. And most importantly, it's probably listening to the employees that you have and the beneficiaries of your services. We're seeing a sharp spike in demand from a lot of beneficiaries for our charities services, and they will know what's changing in their world, as will your employees, because we're all adopting to new ways of working. So again, it's consulting them and making sure you're picking up as many opportunities as you can. I think as well, we're seeing a lot of charities moving to the legacies income stream. You've only got to watch the television to see a lot of the top 5,000 charities are putting out adverts to try and attract new income. They see that this sector might be worth 2.23 billion in 2017 and probably growing. And if you looked at sets of accounts, it represented 28% of voluntary income. So it's well worth tapping in. Maybe you can sign up with a local solicitor. I would say that you do have to be very careful. There are ethical considerations and making sure that you are doing it in an appropriate manner. And the Charities Commission have issued guidance on what you would need to consider if you do go down that will writing and trying to attract legacies for your charity. But maybe it's something you could do on a more local level, not just the national charities, to boost your income at this difficult time. I think when we're looking at how you control the pivot, cash management and funding options is really important. It's looking at your reserves position, which maybe has not had the attention that it deserved in the past. We all have restricted and unrestricted reserves categories in most charity sets of accounts. And it's maybe just looking at those unrestricted reserves a little bit harder and just making sure that they do actually have to have those restrictions. And are there other ways that you can spend those monies? Or maybe even going back to the organisation or person that gave you those reserves in the first place and discussing with them as to whether you could maybe unrestrict them and use them in this difficult time. I think you need to be clear about your free reserves. A lot of charities see that they have a lot of cash in their organisation, but it's understanding, are they restricted cash balances that you have, or are they actual reserves that you can use to meet this difficult situation? I think it's looking at any grants that may be available from other organisations, and there are lots of details if you look on the internet about, organisations that may be able to give you a grant that you wouldn't have considered in the past. And I think it's probably an opportunity to try and increase your income in these difficult situations by applying to them. I think trustees need to be looking harder at what their reserves policy has been and whether that needs to be changed. Your reserves policy should reflect the risks that the organisation is facing at the moment. And I think over the last 6 months, organisations are facing different risks, and looking at that cash management and your reserves policy and what reserves you will need in the future may be changing on a month-by-month basis. And again, it's then looking at maybe the structure. So if you are going into one of these new areas of raising income, just make sure, is that classed as trading? Would that go over the limits that you're allowed? It may not. It may be able to do it within the charity. But if it is, then you might need to think about setting up a trading subsidiary. I think forecasting is really important. I think it's looking at it's not just about the cost cutting. That's not what pivoting is about. Pivoting is about a change in strategy. Part of it might be the cost cutting, and it's really looking about understanding what income streams you might have lost, what impact that has. Maybe it's on timing of that income loss that you need to consider, and looking further ahead rather than just where we are at the moment. And if you get some promises of legacies, be careful that you fully understand when your entitlement arises. People saying that they've put an entitlement in their will doesn't mean that you have that entitlement at this point in time. And be very careful that people within your organisation don't get too excited and start spending that money until it's actually going to be received. There are examples where people have put legacies in wills. Unfortunately, sadly, the people have died, and that legacy has therefore seemed to be materialising. But then there might be a claim against the will, or there might not be enough money in the estate to make that legacy payable. So it's really fully understanding what your entitlement is before you spend the money. I think it's important to make sure, as I mentioned earlier, that we are implementing controls and processes, that you are looking from an internal controls aspect, and also what impact it might have on your reputation as a charity. If you are doing quizzes, you might want a particular type of quiz to have your charity's name attached to it. It's about as well protecting your goodwill and your organisational reputation at this point in time, and clearly document how your decisions have been taken. The danger of doing nothing is that we are seeing income reducing. Unfortunately, job losses are coming through. We can see that Macmillan Cancer Research in September announced that they were making 310 staff members redundant. Help for Heroes in the same month confirmed that they're probably looking at 142 roles, despite a 33% increase in demand. And I'm sure they're not the only two that are seeing this within the sector. So whilst, yes, please do use any government support that you can, job retention scheme, the new way that they're supporting, now we've gone into lockdown, please make sure that you use that as much as you can. But I think there will be more job losses to see in the sector, unfortunately. At the time, the government announced that they were making the 750 million funding to the sector, which was excellent news. Unfortunately, if you looked at the sector, the loss that they could see was probably more like 4 billion. So money is very tight, and we all need to think about different ways of doing things going forward. As I say, maybe having a look harder at what's in your bank and whether any of those restricted reserves could be used in a different way. If you lose control of your organisation, then unfortunately that could mean that your organisation has to fold. You won't be able to help those beneficiaries that you're doing at the moment, or that you might be taken over by another organisation, which in a way you will lose control of that whole process. And it's important that you understand where your cash balance is at this point in time. I'm now going to hand back to Craig to talk about tax and VAT considerations.
Thank you, Linda. Yes, so clearly some very important points there around pivoting, both in terms of the reasons why you might want to do it and also some of the risks that that could entail. And one of them is around tax and VAT, because if you're changing the business model, if your income streams are changing, then you could have a position where all of a sudden you may have a liability to corporation tax. You may have some supplies which are standard rated for VAT, when you're probably used to most of your supplies being zero rated. So the sorts of tax issues that can arise can be around, do you now need a separate trading subsidiary for the new income stream, for the new business model, or can it remain in the charity still? If you are using a trading subsidiary, clearly then there's an additional compliance cost in terms of operating that company, and then you need to think about paying up those profits into the charity to try and avoid any corporation tax liability arising in the trading subsidiary. The VAT status, as I mentioned there, you could be moving to a position of having to record standard rated VAT supplies, which again, from a compliance angle, will be an additional burden from the accounts team perspective. And gift aid clearly is a matter that underpins a lot of the income and donations that charities received. It may be that some of these new income streams can be made under gift aid, and so boost your overall income arising in the charity. So, for example, the retail gift aid scheme is something that you may want to consider moving forward, which perhaps hasn't been relevant beforehand. Now, I just want to move on now to a topic that isn't necessarily about pivoting. Probably isn't about pivoting, to be perfectly honest, but it's a really important change that's taking place from next April, and it does impact charities. And this is around the so-called off-payroll working rules. So these apply if you engage any individual through a personal service company or through an agency, for example. And these new rules are designed to counter what's called IR35 avoidance. So this is paying an individual, but not putting that payment through the payroll. So from HMRC's perspective, they lose out on pay-as-you-earn and national insurance. Now, this was introduced for the public sector back in April 17, and it was due to be rolled out more widely in April this year. However, COVID came along, and fortunately, HMRC took the view that it wasn't appropriate to bring it in this year, so it has been delayed until next April. Now, at the moment, the expectation is that the new regime will commence next April. No further extension has been announced to date. Who's to say whether that will change, over the next few weeks and months? But at this point in time, we do have to work on the basis that these new rules will be coming in from next year. So what does it mean? Well, at the moment, if an individual supplies their services to your organisation via their personal service company, it's that individual who makes the decision whether or not they should be within the IR35 regulations. And this is purely for tax purposes. So are they deemed to be an employee for tax purposes? It's not to do from an employment law point of view. Now, post-April 21, that decision about whether somebody is or isn't an employee for tax purposes, that responsibility now falls on the engager. So this could be on the charity itself. So you will have to make the decision whether that payment to that individual should have tax deducted at source and put through your payroll. So this will clearly result in greater compliance from your perspective. And also there is a penalty regime which will be in place if you carelessly get wrong those decisions. Careless in the terms that HMRC use the word. So what is the scope of the new rules? Essentially, it's any companies, partnerships, unregistered companies and overseas companies. So essentially any private organisation. There is an exemption for small companies, and this is looking at some financial criteria in the accounts. There's annual turnover, balance sheet, and employees. But these are looked at on a group-wide basis. So if your charity has trading subsidiaries, you would look at those criteria across the board, across the overall organisation. Now, importantly, from a charity's perspective, when you're looking at the annual turnover, you do not take into account donations. So, in terms of what is the process for determining the status of these individuals who provide their services to your organisation, we have a term called the client. This is the end engager. So this is the organisation that engages the individual's services. Now, you can use the HMRC CEST tool, which is the Check Employment Status for Tax. Now, if the result of that test and the information has been entered correctly determines that an individual is still outside IR35, HMRC will stand by that decision. There are a couple of warnings here. Firstly, CEST isn't 100% accurate. It's been widely criticised within the profession, and it doesn't necessarily assess all of the factors around employment status consistently. If you don't use the CEST tool, then it is important that you document the rationale behind why you've made a decision, either one way or another. This will protect you, or will help to protect you from any penalties that HMRC could levy for making a wrong decision. You will then produce what's called a status determination statement, an SDS, and that will set out the reasons why you arrived at that decision, and you will then present that to the individual. It's passed down the contractual chain, so if there are several parties in the chain, and there can be in certain circumstances, if there's an agency or an umbrella company, for example, that SDS gets passed down the contractual chain to the payer. So the fee payer is the organisation which has to deduct tax and national insurance if it is an employment conclusion as a result of the status test. The fee payer and the engager, the client, could be the same organisation if there's nobody else involved in the chain. So what do you need to do as an organisation to get ready for these changes? Well, it's important, firstly, that all your contracts and engagements with personal service companies are reviewed. Now, one point here is that you can have a contractual agreement which is very robust from an IR35 point of view, but the actual practicalities and the actual implementation of that agreement and engagement is the critical point. So if the agreement says one thing, but actually what happens in the real life is something completely different, it's what happens in real life, which HMRC will look at in terms of whether that individual could be deemed to be an employee. You need to establish a process internally to ensure that there is consistency in making those status decisions. So you don't want to be accused of favouring one person as opposed to another if the fact pattern on each of those cases is broadly the same. You need to review your internal systems, payroll software, HR and onboarding policies, again, just to make sure that they are fully compliant with this new regime that's coming in. And you also need an internal system to deal with any disagreements on that status determination statement. So the individual can make representations if they feel as though that determination that you've made is incorrect. So again, you need to have some kind of mechanism internally to deal with that. So that's all we wanted to cover off today. Thank you all for listening in, and please, if there are any questions, we'd be delighted to answer them.
Thank you very much, Craig. Thank you very much, Linda. We don't have any questions in the Q&A panel, But what we'll do on the on-demand version of the webinar is make a form available on there. So if anybody thinks of any questions they would like to ask directly after this event, please go ahead and use that form. So thank you very much and look forward to our next one.
Thank you.
Thank you. Bye.
Bye-bye.